APC, accounting for your future.
So, after we look at the financial instruments, recognition as well as the measurement, of course we're going to focus upon the derecognition of the financial instruments, which means when we can take out the financial instruments from the financial statements. Of course, when talking about the derecognition, there would be the derecognition for the financial asset and there will be derecognition for the financial liability. The derecognition for the financial asset is where you have no rights or no risks and rewards. That's it. Those are the two circumstances. You can derecognize the financial asset. You're going to take the financial asset out, from the financial statement. But what do I mean by no rights then? Of course, for example, you enter into a contract now, to buy this thing tomorrow. So after tomorrow, of course, the contract expires. As a result of that, you have no rights for that. You're going to derecognize that. No risks and rewards. A common example I give my students is that customer owes to you $1, but they have paid for you. So that's why you're going to derecognize the receivable. That's the business common sense, isn't it? So that's the second example for the no risks and rewards. But if the risks and rewards is not being transferred, of course, you still have to recognise that particular financial instrument in your financial statement. So this can be linked to the receivable factoring, that kind of thing. So that's how you do it. Debit the cash, credit the loan, because you haven't transferred that risk rewards of that particular financial instrument out. What about for the financial liability then? You can derecognize the financial liability if you have no obligation for that anymore. So for example, I have borrowed $1 from you, but I have paid for you. So do I have the liability now if I have paid for you? Of course the answer is certainly no. That's the reason why we can derecognize the financial liability over here. So, in summary, derecognition for the financial assets, there'll be no rights, there'll be no risks and rewards. But for the financial liability derecognition, if there's no obligation anymore, you can derecognize that from your FS. Okay, so let's have a look at the question then. So, this question is called Thomas within your study note. It's to show the treatment in the above transactions if the asset was classified as the fair value through OCI. So let's say, we're told the question that Thomas held 3% holding of the shares in Smart. Investment is classified as strategic equity, which means we hold the shares is because we want to acquire 100% of shares in that particular company. So that's called the strategic equity. We're going to take that fair value changes directly to the OCI. So valued at $5 million, and we're told the question, the cumulative gain recognised in the equity is $400,000. Which means we can take this 400,000 from the original equity directly to the retained earnings if we're going to dispose of it. On the same day, the whole share capital of Smart was acquired by Gibbon. As a result, Thomas received the shares in Gibbon as a fair value of 5.5 in exchange for the holding in Smart, which means we're going to exchange something. Maybe we have no right to receive any dividends, or maybe we have no right to sell off the shares to generate the capital gain anymore. If we were to exchange that, which means that would be the financial asset derecognition, because we have no rights to receive any benefits of those shares in Smart anymore. And from that perspective, we're going to compare that 5.5 with 5. We have made a gain of 0.5, as you can see. Because the 5.5 is the proceeds that you can get, which means the cash that's given by another company by Gibbon, It's 5.5 minus the 5. And so that we can recognise the gain of 0.5. And because we have a cumulative gain for this strategic equity before of 400,000, which means 0.4 million, so that we can plot these two together, which will give us 0.9, so that we're going to recognise into retained earnings. So you can see the answer below, okay, of what we have just talked about. So that's the financial instrument derecognition.
APC, accounting for your future.